So as you can see from this screen, the title of our recent strategy report was Vex and Relax. Of course, Vex and Relax in the US actually means you vaccinate and you will get free haircuts and free food, but that's not the meaning of our title for our report. Ours was more about compared to 6 months or even 12 months ago, the difference right now in terms of the investment environment is that vaccination is underway. So as you may recall, I think vaccination only started in Singapore in late 2020. And the difference right now is that vaccination is at very advanced stage, at least for Singapore. So that's the positive news. So that's the meaning behind the title, and not so much you get free haircuts for when you vaccinate. So let's move on. Okay, the disclaimer, I know most don't really read it, but I think let me just give a quick run through. I think that's always important just to get understanding. So the disclaimer basically means, no, this is just for educational purpose and not financial advice. The second paragraph is just to remind everyone that what we do is we take public sources, and some of these public sources we can't really verify accuracy. But again, these are public sources like from companies and from database from the governments and so forth. And of course, the other part is just that if you need, it doesn't mean everyone's financial objective, and it's best to also get advice from your financial advisor. Okay, with that out of the way, let's move on. Okay, we usually start off with a review of what happened in the second quarter. So I did brief this to my friend, and obviously didn't really, he was kind of bored with what actually happened in the STI, as you can see. So so if you look at the STI's performance in the first quarter, if you refer to the column on the far left, you can see that the STI virtually did not move. It was just down 1%. We actually was performing well. I think we were almost to the year high in end April. But when the announcements of new lockdown measures, I think the STI, the Singapore market, started to trend downwards. So that was basically what happened in the second quarter. The table on the top is basically just the performance for the first half. So for the first half, we are still up about 8%. So this kind of respectable performance. The rest of the columns you see on the right are the various major asset classes, which I think maybe some of us might have it in our portfolio. So the column on the right is just the REITs. Then on the next to REITs, MSCI Asia Pac ex Japan, just refers to the regional markets, like India, Hong Kong, China. Of course, S&P we all know, US. Then with bonds, so we even underperform bonds. Gold also did reasonably well. This was a positive. And the best performer is actually commodity ETFs. Be it for the second quarter or even for the first half, you can see that commodity ETFs were up almost 30%. So if you had a financial advisor that told you early this year to put money into commodity ETFs, I think you have a good one there. If not, then maybe no comment for that. Okay, I'll move on to the next slide. Then this is just a brief snapshot of the performance of the various sectors in second quarter. Most were in the red, as you can see on the right. On the far right, commodities, what pulled down commodity was mainly Wilmar. So Wilmar underperformed, so that pulled down the commodity. Transportation was like SIA and so forth, so that dragged down performance in the second quarter. On the far left, what did well actually in the REITs for second quarter was some of the healthcare REITs like Parkway, even First REIT. So that actually outperformed in general compared to the other sectors. This is just a snapshot just to give some flavor of what happened. Okay, and we look at the STI components just to have a look at what did well, what didn't do well. Again, this is not predictive, but just for us to have a quick review. So you can see that the banks, DBS was the outperformer. I think the results also was one of the reasons, was probably the results that outperformed the rest. What did well was the cyclicals. I think Sembcorp, a bit surprising, I think Sembcorp, but there was a big re-rating from them, especially on the ESG front. SGX did well. I think SGX, the unique thing about SGX now is that even though they were at one stage, everyone was worried that SGX would be losing the MSCI futures, but what happened was they gained traction with FTSE. Then of course, Yang Zijiang, with the rally in shipping, then what we have is like all the charter rates rising. The Maple Tree ones, I think the industrial REITs, I think, were the ones that outperformed. at the bottom, the Wilma, those stocks that were related to reopening, I think was hurt badly. I think like SIA Sets, Genting Singapore, as the government imposed new lockdown and social restrictions, that kind of just took the wind off a lot of these stocks. Okay, but do know that there were some big winners. I think although the large caps and the STI did not perform that well, there were some big gains in some of the mid cap stocks. As you can see from the second quarter, there were some bigger opportunities for among the mid cap stocks. What happened was that you can see that stocks like LHN, Propnex, the property names, especially the real estate agents, did very well in the second quarter. What happened was that Propnex actually for the full year, most of these companies actually they were one bagger stocks. That means they doubled during the first half of 21. Then some of the iron ore stocks, which curiously these are Malaysian-based iron ore stocks, they also did well. They were although 60% for the quarter, but for the year they were actually up. They actually doubled. So what happened? What you see in the red box is basically we were lucky enough that we covered some of these names like Alishan, Propnex, and Fortress. This is just to give some flavor that it's not all doom and gloom. There were some mid-cap names that did really well for the first half. Okay, I think so. That's all for review. I think we try not to dwell too much on the past. So for the next few slides, we'll just give you a flavor of what is the underlying economic conditions happening globally. So, okay, I'll move on. Okay, so this slide basically just shows manufacturing activity. I think the importance here is that although we get the V shape, as you can see, you get this V shape bounce in the charts, but more important is that it's also getting even higher than the pre-pandemic levels. Like the current PMI, we focus on the blue line, which is the global PMI. The level now is 55, and a year ago it was 48, and even pre-pandemic was 50. So manufacturing activity is gaining a lot of momentum globally. We also see it in the US. So the US PMI is 60, a year ago 51. Just to give you some sense, what is happening on the ground is obviously lots of bottlenecks. If you ask any contract manufacturer out there right now, they will tell you there is shortages, long lead times for almost every component. And what we hear is that even when you go to Germany, there were some surveys done in Germany, and what you see is that there is growth in orders, but the problem is that they can't really meet the production because the orders are there, but you can't get the production because of all these bottlenecks. One of the reasons is that I think the demand was underestimated, so that's why you get a lot of these shortages. And of course, the pandemic itself also causes a lot of bottlenecks in production. So again, this is just to give you a sense of what's happening at the manufacturing front. On the next slide, we will just show you global trade activities is also very robust. I think what you see here is that what we did was we took the 5 largest economies of the world. You can see at the very bottom is a bit small, but like US, China, EU, Japan, India. So we just total up all their imports and see how was that performing. Since these are the biggest economies, so if they import the most things, there's very vibrant trade going on around the world. So you can see that there's actually record imports underway. That's number one. Even in Singapore, you can see a bounce in container traffic, air freight volumes. That's the second bullet point. Of course, the phenomenon right now is that if you try to ship anything, any containers from Shanghai to Rotterdam or Europe, good luck because the prices, the freight rates has actually gone up 10 times. So in the past, it used to be 1,008. So right now it's shot up to almost 12,000. Of course, there are many reasons for this, but one of the reasons is the vibrant global trade. The other thing is it's not only containers, even dry index. So Baltic dry, for those who may not know, basically refers to, you ship, let's say China especially wants to import iron ore, grains, wheat, soya beans, and so forth. So they need to use these vessels called Baltic, dry bulker. So these were also up 60%, and the index now is the highest in a decade. We actually had one company called Uniasia that did a presentation only like a few days ago. So some of the reasons why you see the bulkers doing well is, of course, demand shot up in China, the surge in imports of iron ore. There's also got a lot of congestion in the ports. So because of congestions, COVID, a lot of the vessels are stuck in the port So as a result, there's supply stuck in the port. So it causes a lot of insufficient vessels that can be moving around and so forth. The other reason is, of course, demand. The other reason is, of course, the Baltic index has been pretty weak, so there's not been any new ship orders for years. So it's like a magic combo. That's why the index itself is also doing very well. Again, all this is just for informational purpose, just to give everyone some sense of what's happening out there. And one of the major reasons is you can see here is the big spike you see in the US retail sales. So historically, US retail sales tend to trend 5%, 6%. You're lucky, you get 8. Certain months you get 8%. But right now you can see the big spike. Of course, some will say, oh, this is a year on year, but even if you compare to the pre-pandemic, these are all still record highs. The big driver we all know is due to the fiscal stimulus by the US. So this is one of the main reasons why you're getting this big surge in global trade and of course, the vibrant global economy. Okay, this is my final slide on just on economic conditions. I think most of us know despite the strong economic data, it's actually back to the lows, to 5-month lows. So you can see that interest rates remain at very low levels, and so this is just to show you globally. The blue line is Singapore, the red line is US, and of course Germany, which is negative, which is a negative 20 basis points because it's below the zero level. Okay, anyway, that's for economic conditions. We don't want to push this presentation too much on economy. It's just for everyone just to get a sense of what's going on. So in terms of the macro themes, there are essentially 2 macro themes. Anyway, this picture is basically, we took it out. This is the picture from Venezuela. So what they do is they take all the paper notes, and because it's all worthless paper notes because of inflation, so they take all the paper notes and just they make purses and bags out of it, because the money is virtually worthless, and better value from it by making bags. So we just go through 2 macro themes that's underway. The first theme is, of course, the global pandemic. We show this every week in our weekly briefings, but the main line, I know there's lots of lines there, so apologize, a bit confusing, but the one to focus is, of course, the blue line, which is the global number of cases. So what is happening is that you're getting a delta. The theme one is you're getting a delta resurgence. So that's to give you some sense of why this is this spread so fast. Is that if you look at the first bullet point, that's the R naught. I mean, it's a fancy word, but basically what it means is that one infected person can, how many people can it affect? So you can see that one infected person can affect 2.5, and right now the delta is 8. So basically, one whole family one infected person can infect virtually one whole family, and that's why you get this surge even in Taiwan that didn't get. So you can see that it is 4 to 5 times. It spreads 4 to 5 times even more than the original variant. So that's why it's quite alarming. That's why it's even spreading now in the US. Okay, there are risks, of course, when it comes to this. First, nobody can predict the mutation. I think it's important for us to remember that. And also, we cannot predict, no one can tell you that you can predict the immunity of all the vaccines to the variants. So that's going to be the risk for all investors. And please don't ask me, because I have no idea what will the mutation, the variants or constants, how worse can it be? But that is the risk for all investors, because this is the big unknown out there. The other reason why you see this bounce back in cases is a lot of lockdown fatigue. I think not everyone is opening up, and they'll be locked down for too long. So you see many countries with new record highs. I think the worrying one for us, at least here, is Malaysia and Indonesia. Malaysia had a new case, and why this is important? Because some of the listed companies, as you know, even people like Venture, a lot of the glove makers, they have production facilities in Malaysia, and most of them now have to operate at 60% capacity. So it is important that these things do affect some of the listed companies. Of course, Indonesia have also some of the record numbers. Okay, in terms of for Singapore, the good news is that for Singapore, you can see the red line basically is just the moving average. You can see that we had this big surge, the second this surge, and then what has happened is that it's already collapsed down to the lows. I think it's all over the press, it's like single digit. So the one thing is that the authorities now, the key difference compared to even a month ago is that they are now managing it like a common flu. So as an investor, this is very important. So this means that you can expect a bit more aggressive in their attitude in opening up in all the social distancing rules. So what has happened is that they consider this an endemic. I think we all keep on hearing this. And important that there's a change in attitude and even the narrative that they may not even give details of community cases and so forth. So how we read this is that if the three milestones are achieved, you can see in the middle, what it means that you're going to see very aggressive reopening. No big bang, but you can expect like cinemas, entertainment, large events to open up. You won't get these lockdowns for F&B and retail. Maybe you will be less working from home. So these are important for a lot of stocks in Singapore that are not very domestic oriented. The other metric we monitor is the single dose levels. Why this is important is because the big magic number is 80%. I think the commentary has been, because to account for all the variants, to get this so-called herd immunity, we need like a 80% fully vaccinated. So right now, the single dose is 65. So if you get single dose 80, then it's very good chance that I think we're going to get very aggressive reopening, at least locally. The last point is travel is unknown because you know how we're going to travel to Malaysia right now, got like 9,000 cases. But at least what we are doing is that we want to focus on those stocks that rely, that is domestic oriented, don't really rely that much on international tourism, that we can see that it's a way to just play on the reopening of Singapore, especially the October timeline. Okay, this is just to we actually monitor ourselves the level of vaccination globally. So the good news is that I mean this is not very. It's just simple maths, and just like we take like the daily average people who are fully vaccinated, then we just kind of extrapolate it. So the good news is that Europe and US can get fully vaccinated by this year. So I mean, Europe, if they continue with this pace, like 98%, US is 80% of population. Globally is a bit tough. So by year end is at most is I mean maybe 29 or even 30. I think WHO's target is 40%. So this is just for information that the good news is that the developed countries are getting fully vaccinated, and if there's any place to travel, that's probably going to be the likelier spot than our neighboring countries. Okay, the next theme, just 2 or 3 slides for me, is basically inflation. I think it's everywhere in the news, all about inflation, no worries of inflation, any surge in interest rates. So for us, just a reminder, the Fed's target is the red line that you see. Inflation now has actually surged past that red line, but from the Fed's point of view, this is only temporary and it's nothing to worry. And I think the Federal Reserve, our point of view is that their employment is obviously going to take prominence. So they don't mind high inflation because what they want is to recover some of the lost jobs, which since the pandemic, in the US, there's still like around 6 million plus jobs that have been lost and not recovered because of since the pandemic. My own view is that although the expectations is a rate hike in 2023. What may happen is that as we move into next year, 2022, if the global economy slows, you may actually be a situation where the Fed may not even want to raise rates in 2023. They may actually want to push it to 2024 because at that time they might even say that, oh, global growth is slowing down, US growth is slowing down. We may not want to raise rates again. So I'm a bit more apprehensive of any rate hike, even in 2023. We think it could even move to 2024. And you know, if you historically, if you look at the last time the Fed raised rates was 7 years, it took them 7 years to raise rates. So this time around it's only like 2-3 years. So historic, and also, you know, in Japan it's 20 years before. Also, after 20 years in Japan, they still have not raised rates. So I'm a bit more sanguine about any rate hike. I think it could even push to 2024, because in a way, by next year, if growth do slow down, the Fed is a bit stuck because they can't be raising rates when growth is slowing down. So that could be a situation, again, it's not prediction, but that could be one situation where interest rates will remain quite low for a while compared to expectations. Anyway, for us, we don't think there is, as we put on our economist hat for 5 minutes, for 2 minutes, we don't think there is runaway inflation. So this is the US inflation rate since the 1960s. So you can see the big spike in inflation that the US faced in the shaded area 1970 to 1980. But so from our point of view, I mean, just using numbers rather than being an economist. So what we did was we just took the condition. So if you look at the box there, between 1970 to 1980, the average inflation, which is the core, let me take out energy price and so forth, was about 7%. So right now it's 4. But the main difference right now is during the 70s, there was huge loans growth. So the loan growth was 11, right now it's only 4. Oil price jumped up 10 times. Right now the oil price is, compared to 10 years ago, was down 30%. The only thing different, similar is unemployment rate. And of course, we all know the bargaining power for workers, trade unions is anecdotally, I think we all know that it's much lower than what we had in the 1970s. So the conditions are not right for any like so-called hyperinflation. And this is important because if there is hyperinflation, then the Federal Reserve will have to prematurely kind of raise rates. I mean, there are other structural reasons, but I won't go there because aging also has another factor why it's also another pressure downwards on rates because it affects aggregate demand. But again, no, don't want to go too heavy on the economic part. But I think this is my last slide. I would hand over to Wei Ren. He would just give some of his views on the market, and he will also give his views on some of his top picks from the technical point of view. I think it's all more interesting. The rest were the earlier parts were all economic theory and so it may not have been so interesting for the rest of you. Okay, I'll hand it over to you, Wei Ren.
All right, thank you very much, Paul, for the wonderful presentation and the introduction. So I just move on. Today I just touch on the STI, and then for this Q3, I will also talk about the update from what has happened in Q2 and then what I've shared earlier on. So what's the update, and then what have gone through or what have not. All right, so compared to Q2 and Q3, what I didn't do in Q2 is I didn't have a monthly chart. But I decided to have it for Q3 because I think that is appropriate right now. And then Q4, let's see how is it going. All right, so first of all, you can see that throughout from the year 2004, 2007 onwards, all right, that was when STI reached its the highest point ever. All right, that was like 3,000, nearing 3,900. And then the financial crisis came, and then price formed a true wave down in the money chart. You can see, right? So you can see that after the wave 1 of the cycle phase has been formed, and then you have the A wave that is marked out in 3 waves. All right, so throughout this, you can see that you connected all the dots together, particularly from 2009 to 2020. You can see that they are actually converging into a 5-way symmetrical triangle. While some may argue that it is not really that 5-way triangle, it may be something else. Don't worry. On the next chart, I will show you another alternative count. Okay, so let's just bring back to the 5-way, all right, 5-way triangle. So you can see that the B leg actually make up of a lot of sub double tree corrective in the chart. All right, so it start range from 2010 to all the way to 2017, so a period of like 7 years. STI was in a very much double tree corrective phase, which is very applicable to wave B. Like wave B can be any zigzag wave and some sort of like a complex double tree or expanding flat curve corrective wave. All right, so after wave B, wave C is where 2018 to 2020 happens. All right, where the C leg was where the COVID sell down happened. All right, last year 2020 March, actually February it started. All right, rebounded going to New Year. I think last year Q3 the rebound from STI was strong. It rebounded at 2002 and then rebounded. But right now we are maybe in the some minor correction. I don't believe that there will be a major correction right now, which I later I'll show you on the daily chart. All right, so the upside will be likely to cap at 3,005 in the long term. All right, and then after that, there'll be the major correction down to wave E to back to the support zone at 2002 before rallying to a bullish wave. I need to let you know, guys, that this is a monthly chart. So 1 bar equal to 1 month. So the wave from wave D to wave E, the potential downside, it might not happen this year, and it might happen only like 2-3 years. All right, this is just a projection. Anything can change. All right. Okay, so the next slide, is actually on the next slide is actually on the sorry, there's some technical issue. Let me yeah, the next slide. All right, so thank you. So right now we're back. Okay, so next slide. Okay, if we removed the 5-way triangle, you can see that we instead we do in the ABC kind of like a corrective flat pattern. You can see that the B wave is actually the C wave. Instead of like a double tree corrective wave on the B wave, we can do on the C wave as well. So more or less we are completed right now. So if you can go into the subwave, all right, so like the recent one, the rebound, especially after that, I mark A or 1, B or 2. So what the reason why I did that is because I need to gauge whether this will be the impulse wave or not. All right, so what are things to look out for if we are looking for an impulse wave? So first, if the rebound, the rebound is on the I mean, if the rebound after B or 2 is going to be an impulse wave, that will be a wave 3. So minimally, I think that first condition, the correction shouldn't dip below the immediate resistance zone, which is around around 3,000 to 2,009. So that area must be supported. Okay, if that area dip below, and especially dip below to 2008, then you'll be another 3-wave corrective. There'll be, instead of like 1, 2, 3, will be A, B, and then C, and then that whole wave will be X wave, and then we got a Y wave further. So in my opinion, what do I think? Even if it hit the wave 3 minimum target at 3449, I think, or 3005, I think is still going to be a very much corrective wave. So which complement what I shared earlier on the 5-wave chart on the SDI money chart. All right. So the next one I'll show is the weekly chart. Okay, so the weekly chart is actually basically from Q2 and to Q3. You can see that I forecast that during in the Q2 stock pick and strategy back in April, 3rd April, right? That will be a major correction that will go down and touch support zone 1, and then therefore it rebounded. All right, but the rebound wasn't that strong. Resistance zone 1, daily resistance zone 1, at the zone, you can see that is around 3,002 region was faced with some rejection. Prices did came down, but you can see that there's like a graveyard doji at that area, so it shows signs of rejection going there. So hence, I think that there will be the bullish flag that will form a sub 3-way corrective wave down to support zone 2, which is around 2009 or 3000 level. It may be a wedge, it may be a falling wedge, which is a sign of a bullish reversal, or it will be a bullish flag as well. Will there be an surprise upside? I highly doubt so, but if there is a surprise upside, that means that Monday, if there is a gap up of a resistance zone 1, then means that the pattern is fulfilled. But I think that even there is a surprise upside, I think resistance zone 2 will be highly resisted, and then the strong selling will start at resistance zone 2. So we can see that my first target price is 3,345 by end of 3rd quarter, which is around September period. And then but whether it is going to meet earlier, or whether are we going to have a correction down to support zone 2, back up to the 3,345, or what? Let's see. All right, but 3,004, I think, which is the higher end of the resistance zone 2, will be by end of 2021 period, or maybe earlier Q1 2022. All right, so the next one is the daily chart, which shows the daily chart, which I have put in the daily chart. The next slide on the daily chart. Yep, thank you. The daily chart has shown that it most likely is going to be very much in the range. First up, I think the Ichimoku is showing on the Ichimoku is showing a very much tight range market for the SDI. First up, is not trending anywhere. First, why is because the Senko span A and B remain flat and is citing low volume. And then the lagging span, which is on the black line, the Chico span is actually it is actually on down, it is trending below the candles. So hence, I feel that any downside is likely to be to remain with a hinge of a upside. Okay, which any upside will be kept at in the immediate resistance zone 2, and then there will be a correction down. All right, if it breaks, then that will be great. All right, then it confirms the weekly pattern which I shown earlier on. Okay, so I think next Monday there is likely continuation of an upside again. All right, the previous slide, please. So sorry. Yeah. Okay, so yeah, I saw some comments say that there's no screen. You can type one or something to see if you can now is it an STI daily or what? Okay. All right, so the next slide will be on nanofilm. Okay, so nanofilm was one of my stock pick in Q2 2020, where price actually did meet my expectation, but the correction down to support zone 2 was like unforeseen. But since then, it has really rebounded very strongly. Okay, right now, nanofilm has already made a new high. All right, despite like a bearish candle yesterday, fortunately, it did not close as a dark cloud cover. All right. The reason why is because I think at the last hour there's a slight rebound. So, if you measure the bullish candle, which is on Thursday, the bearish dark cloud cover didn't really like fill up 50% of the bullish candle. So, we in this retrospect we are quite safe. However, I think in order to confirm the subwave 3, the target resistance zone 2 must be broken to and then achieve a target at $6.62 without any retracement back and break below the resistance and support zone 1. All right. Okay, so next one I think I will share on CapitaLand. So the CapitaLand weekly chart. Okay, so why are we so strong on CapitaLand? You can see that every time CapitaLand has a touch above the resistance, which is around $3.80 to $4 region, that level. Okay, so let me do a double check. Okay, so it's yeah, $4.04 region, which is the resistance zone 1, the weekly resistance zone 1. You can see that it has been tested multiple times. All right, and then prices was supported at 250, rebounded, test again after gap up. It fails to clear resistance zone 1, but never mind. The correction down was supported by the gap zone at $3.25 to $3.50 support zone region. Is kind of like a strong gap up. All right, and then price is likely to break on the next instance. All right, for CapitaLand. All right, so long-term target, mid-term target, I'm looking at $4.45, and then long-term target we're looking at above $5 at resistance zone 2. Long-term target is around 2 to 3 years later. It depends. All right, so likely we can see some more ranging within CapitaLand in the next coming weeks. All right, so on the daily chart on the next slide. All right, yesterday I did issue a report like 2 to 3 years on okay, let me recall. Okay, so 2 days ago, I issued a CapitaLand technical report, buy above $3.77. So price did correct after that, but yesterday there's also bullish engulfing. Means it signified that although the bullish engulfing happened at the near of the uptrend, it signified that this rebound closes back above the uptrend line, you can see. And then it has some sort of like the Bollinger Bands contracting. So any break to the upside will be tremendously strong. So these are my target price at $4.10 by end of the quarter, and then target price to at $4.38 by end of fourth quarter. Okay, so I saw one comment, say 2 to 3 years later, no more CapitaLand. I'm not very sure, but I think CapitaLand still, if not, Template Small will be gone. All right. Okay, so the next one will be Del Monte. Del Monte, why this stock is because I went through the monthly chart and I saw it's something interesting. The falling wedge has broken. All right. From 2020 to all the way to this year, it has been on a strong bullish run. Okay, just that the resistance zone was like there was a monthly shooting star down of the resistance zone, and then straight away starting the month of July, there was like a resurgence back of the bullish candle. Although it's not confirmed yet because we are starting of the month, it's not confirmed yet. All right. Okay. But I think that is most likely to be profit taking at the resistance zone, and then you breaks up above, and then you target 60 cents, which is around 61.8% Fibonacci retracement. All right. Okay, so the next slide will be like the daily chart. Okay, so the daily chart, I just want to focus on the now. All right, so you can see that the extended wave tree has formed. So in the short to mid-term, we could see that there are some more upside going on. All right, after the correction. All right, so it will be A, B. B is likely to complete soon. All right, so we can see that B will be targeting at 0.4550 cents. Form a bullish flag, upper bound of the bullish flag, and then correction down to support either support zone 1, with 36 cents to 39 cents or 31 cents to 33 cents for support zone 2. All right, so this is what we are monitoring, and then Del Monte will definitely be a strategic play. All right, okay. Let's see. All right, so that's all for me, and then I pass my time back to Paul. Thank you very much.
Okay, thanks, Viren. We wanted to do something different and just to put some fundamental overlay on his technical call. So we do have this thing called Phillip on the ground. For those who don't know, every week we actually brief investors for some of the not every investor gets access to a lot of the corporate briefings. So we always have this thing called Phillip on the ground, where we will just brief everyone on what are some of the key highlights of a particular meeting, analyst briefing, or even group meetings, or for investors that may not have been able to be there or even attend. So for us, when we looked at Del Monte, the last briefing that we had, the outlook, we don't have any coverage, is non-rated, but the outlook looks interesting. Just to give you some color, I think Del Monte used to be it's a very strong player in Philippines for juicers and so forth. Then what happened was in 2014, rightly or wrongly, they actually made a big acquisition of Del Monte US, which if you see on the picture, is they sell mainly canned vegetables, canned beans, and so forth. And as a result of that, they took on a lot of leverage, and it took them maybe 5 to 6 years to turn it around. So right now, the outlook looks promising because what has happened, they closed a lot of factories, they introduced new products, they go into food service, which is your QSRs and so forth. And also they exited a lot of the very low margin private label and government tenders, because in the past they were focused more on the production rather than on the branded goods. And they even raised prices, I think in May and so forth, because previously they were owned by a private equity company. So that's the positive thing, the turnaround in US. The second is in Philippines. They have very strong presence in Philippines. I think they're the market leader with huge shelf space, and they are going to raise their distribution points, which was surprising. I thought they were already very well penetrated from 91,000 to 200,000, somewhat similar to a Unilever or P&G. And also they launched a new product, dairy product. You can see the picture at the bottom right. And also in China, they sell mainly fresh fruit. I think we all know what's a pineapple, but anyway, it's the picture on the top right-hand corner. And the good thing about fresh fruits is that the margins are high. You just have to. It's more logistics than anything else because you don't have to do much processing. The next driver we think is the IPO in Philippines. So what is happening is that because of the acquisition in US, Del Monte is burdened with a huge 100 million of interest expense. So this IPO would also help remove their preference share dividends, which is dilutive because preference share dividends actually is taken out from your earnings per share, and that of course affects PE. So this IPO could be another re-rating catalyst because it will help improve the balance sheet. And the next benefit apart from operations is that if you do well, you earn profit cash flows, you can actually reduce the interest burden, which is huge. I mean, 100 million. So we think, although it's non-rated, just that the outlook fundamentally also looks interesting. This is just to add color to Viren's technical call. We just wanted to do something different. Okay, I will move on. We'll just give you a few slides on what are some of the sectors trends or sector commentary on for those listed on SGX. I'll move on to Natalie. Natalie, over to you.
Hi, thank you, Paul. Good morning, everyone. Okay, so we'll start off with the property sector. Okay, so starting off with the graph, as you can see, this is the price graph of all the private residential indices. You have the landed, and also of course the CCR stands for Core Central Region, RCR Rest of Central, and OCR out of Central Region, as well as the HDB Resale Price Index. So all of these graphs here are pointing upwards, and as we know, the property market has been on sort of a bull run here. Overall, the private residential price index was up by 0.9%. in the second quarter of 2021. It slowed slightly from the first quarter of 2021, where the index actually grew by 3.3% quarter on quarter. Okay, just pointing out the last column of the table, we see that the HDB resale price index year on year was up by about 10.8%, and this of course was due to construction delays. With regard to your build to order BTO kind of HDBs, as well as some of the private residential projects that will be facing a longer timeline for delivery, and that of course has led to some demand for resale flats. Okay, so year to date, for May year to date, the new home sales excluding ECs came in at about 5,700 units, and this was 90% above the year to date 2020 numbers. So just to give you some context, this is about 55.5% of 2020's sales figures. Okay. Overall, the government has also increased the number of GLS, government land sales, by about 25%, half on half, to 2,000 units for the second half of 2021. For the past 2 years, the amount of units actually released under the government land sales has been kept between 1,300 to 1,700 units. So this is an increase. Overall, is still considered a positive for the property sector, as it will help to allow developers to replenish their land banks, and also sort of reduce the impetus to quickly push up the land prices to replenish their land banks. Okay. Overall for the developers, they are still trading at about 40% discount to NAV, and this is a relatively attractive valuation still. And we prefer developers with higher recurring cash flows. So as this actually provides a bit more stability in for their earnings. So higher recurring cash flow can come from ownership of your investment property, such as your malls, your offices, your industrial assets, and that will actually provide recurring rental income. Okay, now moving on to the REITs sector. Starting off with the graph, we see the light blue line here, which is the FTSE REIT index. Overall, you can see that it has been actually trending sideways. And the darker blue line here is actually the dividend yield spread. So this is the dividend yield minus the 10-year risk-free bond rates. So that actually means that how you understand this chart is if the REITs are trading below the red line, it is when your dividend yield spread is actually lower. The risk that the reward that you're getting above the risk-free rate is actually lower when you're holding REITs. But conversely, when you're buying at above the red line, that is when you are getting a higher return. Okay, so overall, right now we are looking at the trailing 12-month dividend yield spread. And it is at about negative 1.4 standard deviation level. But if you look at the forward dividend yield spread, meaning forward looking for this year, 2021, the dividend yield is actually 5.1%, and that will actually give us a 3.6% standard 3.6% yield spread. So that means we are actually about slightly above where the red line is if you're looking on a forward-looking basis. So the last point I want to touch about on this slide would be the interest rates. Overall, we see that interest rates currently as of 7 July, the 10-year bond yields are about 1.44%, and similarly the SOR is at 0.22%. And overall, the 10-year bond rates are actually still below the 5-year and 10-year averages. And if you recall, in 2019, it was a bull run for the REITs. And even during that time where REITs were aggressively acquiring, the interest rates were at a higher level compared to where they are now. So that actually just means that there is still a lot of opportunities for the REITs to acquire accretively. Okay, now moving on to the next slide. So the graph that you are looking at right now, this actually shows you the DPU growth year on year. So in FY20, the far left side of the graph, we see that across the subsectors, the DPU growth was of course lower. Hospitality DPUs fell by about 60%, and then we have retail, which was down by about 23%. This, of course, was largely due to a lot of the rental rebates that were offered to their tenants. Hospitality also down. The only sector that was slight positive was the industrial sector, which DPUs grew by about 0.7% for the REITs under our coverage. Moving into FY21, we're of course expecting a resumption of DPU growth, very strong DPU growth for the hospitality and the retail, but this is of course due to a lower base that we saw in FY20. Okay, and if you recall, I mentioned that the 10-year bond yields are about 1.44%, and according to Bloomberg, we are actually seeing that the consensus forecast is that the 10-year yields are gonna remain below 1.6%. Yeah, so what that means is that the DPU growth will outpace the interest rate growth. Yeah. So that actually, as I alluded to earlier, the interest rates are conducive, and we expect the deal momentum to continue, and this will fuel inorganic growth and help with the DPU recovery. It will hasten the DPU recovery. Acquisitions will also of course lead to better diversified portfolios, as some of the REITs will pick up more future-ready asset classes. As the transaction markets actually open up, we also see that the REITs have seen opportunities to divest some of their assets, and divesting at very above book. So that has actually led to some unlocking of value for the REITs as well. Another point is that the accelerated vaccine rollout. This, of course, the vaccination should reduce the rate of infections, and actually hopefully means that there will be less tightening of containment measures and snap lockdowns, and in general, less business disruptions for the REITs. Okay. Of course, if all things go well, we can also potentially see an accelerated resumption of international travel, and that will of course bring back some of your tourism dollars and will help the retail REITs, and of course it will help the hospitality REITs as well. So I think that's about it for me. I'll now pass the time on. No, that's not. Okay, sorry. Now I'll move on to the subsector views. Okay, starting off with the retail subsector, we are overweight on the retail subsector and our preference is for suburban malls. And this is, of course, due to their resilience. They are located near, in close proximity to households. And households, of course, they contribute to necessity-driven spending. Yeah. The increased daytime population due to flexible work arrangements are also a positive for the suburban malls. Okay, so in general, we do expect that the demand for space at suburban malls to be more resilient compared to downtown malls. For the retail subsector, we know that there has been some change in lease terms. Due to the pandemic, a lot of the landlords have actually sort of adopted a higher risk sharing model for their leases. What this means is that they actually lower the base rent while simultaneously increasing the variable rents. So these variable rents are, of course, a percentage of the gross turnover that the tenants are, the sales of the tenants. Okay. In general, because rental reversions are actually measured based on the base rent, the lowering of this base rent will definitely lead to some negative reversions, and this is expected to continue. Yeah, especially for the next perhaps 2 years, where the leases expire. Okay, in general, the May 2021's RSI excluding motor vehicles, it was negative at 8.9% below 2019 levels. So of course, we are actually quite close to the pre-pandemic levels, but the RSI has not yet, especially for the month of May, is not back up to the level of 2019 levels due to the absence of tourist receipts. The catalyst for the retail sector will be, of course, the return of tourism spending and also increase of purchasing triggers as more events are allowed to continue. You have more reasons to go out and buy clothes, etc. And that will lead to a higher GTO sales for the tenants. And as I earlier mentioned, because of this higher risk sharing model where the tenants will be taking a larger percentage of GTO revenue, this will help the REITs. Also, now moving on to the industrial subsector. So the industrial subsector is the subsector that we believe are beneficiaries. In the June 2021's PMI Purchasing Managers Index is 12th month of expansion, and for the electronics, they were in the 11th month of expansion. So that's of course very positive for the manufacturing sector, the orders coming through. For the rents and occupancy for the industrial sector have been on the uptrend. The rents have bottomed out in the last quarter. For the asset classes of the data centers, high-spec business park and warehouses, these asset classes remain in demand, and they are supported by new economy sectors such as your biomedical, life sciences, precision engineering, and your logistics. And while the light industrial asset class actually does face a little bit of challenge because of the supply that is coming onto the market, the Singapore government's 10-year plan to double manufacturing will help to soak up some of this excess supply. The manufacturing sectors that are expected to that Singapore expects to draw to our shores will lead to demand for the light industrials, the high-spec assets, and also might flow over to the business parks if some of these overseas tenants would like to set up headquarters in Singapore. Now moving on to the office subsector. We are neutral on the office sector, and even though we have noticed some uptick in leasing inquiries in 2021 versus 2020. Overall, the tenants are displaying a mixed response. There has been a mixed bag of renewals. Mostly renewals for the office tenants, and of course there's been a little bit of downsizing, expansion, and non-renewals. So it's a very mixed response. The 5-year supply coming onto the market averages about 0.7 million square feet per annum, and this is below the 5-year average of 1 million square feet per annum. Not to mention, in 2021, 2022, we are expecting some redevelopment to take off supply from the market. So some of the assets that actually undergoing redevelopment are Fuji Xerox, AXA Tower, as well as Central Mall. Yeah. Yeah, so to sum things up, the office subsector is facing a little bit of a structural decline, and we are cautiously watching it, so we are neutral on the sector. The last subsector for me would be the hospitality, which we are neutral on. So hospitality faces a fragile and long road to recovery. We're expecting recovery to come in around 2023, 2024, recovery to pre-COVID levels, that is. So we think that the prices have sort of moved ahead of this recovery timeline, hence explaining our neutral call. Overall, how the Singapore hospitality market is doing, as of May 2021, RevPAR was 64% below 2019 levels, and occupancy for the sector was 49%. Some of the hospitality players have noted that forward booking visibility has improved. There's good demand for advanced bookings. However, of course, some caution remains due to new waves that might lead to cancellation and postponement of bookings. Yeah, overall, we think that the leisure demand will help to lead the recovery. Be it currently the kind of leisure demand we're seeing is very domestic in nature, and countries with large domestic markets will be the first to recover. And some of these markets include US, France, Germany, Europe, Japan, and Australia. Yeah. So that's all for the REIT subsector. I'll now pass the time on to Terence.
Yeah, thanks, Natalie. So for the banking sector, we think that there are really two main things that investors should pay attention to. So the first one here is the allowances reversion. We expect this to continue in financial year 2021 and financial year 2022. We provided a table here on the left-hand side. So if you look at the table here, not sure that you can see a table here, but for the three banks in the fourth row, for the three banks, you can see the general provisions that the banks made in the first quarter of 2021. Of course, we are expecting the banks to make their second quarter announcement or first half 21 announcement in a few weeks' time. But we expect DBS and also OCBC to actually make general provisions reversions in the second quarter of 2021, because one of the reasons is because they already made very significant provisions in 2020. So all the provisions it is way above the regulatory limit required by MAS. So essentially what this means, just to make it very easy for everybody, is when the banks do this reversions, then your net profit will jump because you no longer need to provision for some of these bad loans. So in 2020, just to recap, in 2020, they were really expecting a lot of these bad loans to materialize, especially for the weaker corporates. But what happened is that in 2020, what happened is after the loans moratorium in 2021, they realized that a lot of these bad loans didn't materialize. So they actually over provision, which is a good thing. But for DBS and OCBC, what they will do is likely just reverse this out for FY21 and 22, because no point making over provisions. So the second catalyst we believe for the banks, and really everybody is waiting for the announcement by MAS, who is currently doing a review of a stress test on the banks to determine if the banks are able to meet the regulatory requirement in terms of the defaults. So right now, for us, we see there a very strong capital position for the banks. The bank's capital position is about 14.6% on average. You can see this in the common equity tier 1 ratio. And this is the last row here. You can see it's all way above the ideal operating level of 13%. So we think a lifting of the dividend cap. So again, recall what MAS did in FY 2020 was to put a cap on the bank's dividend by capping their dividends to 60% of the dividends that they can pay in financial year 2019. So when they put a cap on that, obviously the returns are capped for the banks. But what the banks have already said, especially during the first quarter 2021 results with them, is that the moment the MAS lift the dividend cap, they will resume the dividend payout back to the 2021 levels immediately. So that would be good news for the banks in terms of the three banks. In terms of when the announcement will be made, we are not sure, because this is based on MAS timing, but MAS did say that an announcement will be soon. So I think that there are really two dates that internally we are looking at. The first date that we look at for the banks is they could make an announcement in the next couple of weeks, because we expect the banks to be making their second quarter 2021 or first half 2021 results announcement in the first week or last week of July or first week of August. So what happens is, if MAS can make the announcement to lift the dividend cap in the next 2 weeks, then the banks could potentially announce that all three banks could potentially announce a resumption of the FY21 dividends in their second quarter 21 results. And also don't forget, because this is important, because OCBC and UOB pay half yearly dividends. So if they miss the date in the next 2 weeks, then the next possible date that they could make the announcement is probably in September and October, just before that will just be before their third quarter results announcement. So because amongst the three local banks, only DBS pays a quarterly dividend. So if they resume or they lift the dividend cap in September or October, then what will happen is that DBS will immediately be able to declare a higher dividend payout or a resumption in the dividend payout, but OCBC and UOB shareholders will then have to wait slightly longer. So generally, I mean, obviously, to take a step back, the timing of the dividend payout is not that important, but of course, for some investors who are waiting for the resumption of the dividend payout, the timing will matter. Obviously, the hope for the market is the sooner the better, because at least they will be able to resume the dividend payout. But even with the reversion of allowances, even if we look at the allowances reversion in FY21 and FY22 and loans growth stabilizing, we even with those two aside, we also expect the fees and commission to grow 22% on a year-on-year basis for the full year 2021, and for full year 2022 we also expect about 18% year-on-year growth. So when you look at the bank's non-interest income, the banks are also still growing it at a very, very fast pace. So overall we are positive on the outlook of the banks going into the second half of 2021 and also for 2022. So that's all from me for the banks. The next sector outlook in my next slide will be on the offshore and marine sector. So for us, the offshore and marine sector has come under is really one of the hotter news in the market right now, and we see, obviously, just to bring everybody up to speed, the Keppel Corp and Sembcorp Marine recently announced two major transactions to really create this global champion, which is the long-term aim of the group. So for Sembcorp Marine, they announced two main transactions. The first transaction that Sembcorp Marine announced is that they are doing a 3-for-2 rights issue. This 3-for-2 rights issue is currently ongoing, and they expect the completion of the rights issue to take place in the third quarter of 2021. The second announcement that Sembcorp Marine has made is that they have signed a non-binding MOU with Keppel Corp to explore a potential combination between Sembcorp Marine and Keppel O&M. So these two announcements that Sembcorp Marine will make is to attempt to create a global yacht champion to compete for O&M contracts in the O&M market. So the justification for Sembcorp Marine is that, and also for Keppel O&M, is that the combined entity will allow the group to pursue synergies from a combined operational scale. So they expect to benefit from revenue synergies, cost synergies as well, and also benefit from technical expertise and skills of the two groups when they merge together. Whereas Keppel Corp also announced two major transactions. I'll be very brief on this because we will talk about Keppel Corp slightly later again in detail. But what Keppel Corp also made two major announcements. The first major announcement that Keppel Corp has made is that they are farming out two of their existing business, RigCo and Development Co, and combining these two entities into Asset Co. We'll provide a chart slightly later. But So we'll just be very brief here again. They combine this into asset co, and this asset co, Kyanite Investment Holdings, which is a wholly owned subsidiary of Temasek, will take this entity and look for external investors to take a stake in these holdings, which is so they expect to procure external investors for Keppel. So it's a good deal for Keppel because they don't even need to look for the investors. Temasek will look for them. So once the external investors take control of REITco, Development Co, about 80% of this will be held by external investors. Keppel will only hold about 20%. So what that does for Keppel is that they will be completely rid of the entire, almost completely rid of the O&M business, and allow them to focus on the focus on their other growth businesses. So that can be a positive for Keppel shareholders. And obviously the second announcement that they make is the non-binding MOU that they signed with Sembcorp Marine. The long stop date for the completion of the agreement, we understand from the Keppel Group, is the fourth quarter of 2021, and I think that's to account for the rights issue by Sembcorp Marine. And should the agreement take place, again, there's no certainty in terms of whether the agreement will take place. We also want to warn that it could fall apart as well. But if it goes through, the potential completion is expected we expect the completion to be in the second quarter of 2022. So in this regard, we are overweight on the sector, but more specifically, we are overweight on Keppel in the near term. We'll elaborate a little bit on this later. So that's all from me. I'll now hand over the time to Paul.
Okay, thanks, Terence. We just have 4 or 5 slides. I'll run very quickly because I think probably topics are more important. So for the healthcare sector, just to give you some flavor, in a nutshell, healthcare is booming. I think you can see from the chart itself, but the chart is only up to February. I'm not sure why the MH is so slow, but what is happening on the ground, at least, that I guess all of us are stuck at home, and then with a higher discretionary spending, what you see is that if you try to go for health screening, aesthetics, dental, I think the bookings are quite full. I think what has happened is that medicals, as the title suggests, medical used to be just for essential reasons, but what has happened is morphed into more discretionary spending. I think with more income and with less travel, I think a lot of the budgets actually moved into healthcare, aesthetics, and dental, and so forth. The other phenomena is medical tourism has hit, but it's mainly on the higher end services. Oncology especially has been hit, and there is a worry in the medical fraternity that medical tourism will return as pre-pandemic, because what if they were to switch to domestic healthcare facilities instead? So that we can't really answer, but that's one of the talking points, I guess. But in a nutshell, it's just booming. The next is just land transport. Apologize for this chart. I try to smooth it out as much as I can. So this chart basically is from Google. So what it shows is the activity. The blue line is retail activity. That means this movement of people go to retail places. Transit means the number of people that go to the LRT, MRT, and workplace. How many people go to office? That's not me because we're all working from home. But what you can see is when the circuit breaker hit, the numbers all collapse. So the Google mobility data is actually very accurate, and it's actually on a daily basis. Then when we entered phase 2, it started to climb. Phase 3, you can see the numbers were a bit sideways. Then phase 2 HA, you can see, I mean, it's very clear that everything just collapsed back, but didn't drop back to circuit breaker, but it dropped to phase 2 levels. So what this means, at least for the land transport, is very negative. Obviously, I think although real numbers are up year on year, but I think you can see from here the transit numbers are dropped quite dramatically quarter on quarter. What has happened also, taxi waivers have returned, and also any recovery in land transport. Then this is essentially a ComfortDelGro slide, but any recovery expected is delayed. And also the other thing happening on the ground is, of course, the taxi fleet is also down, but rental cars are actually falling more than the taxi fleet. But we still remain overweight. I think we'll explain later in our ComfortDelGro slide. Next is air transport. I think it's pretty evident what's happening. The chart is the amount of passengers carried by SIA. So although the share price is down, but actually SIA's market cap is up. We are a bit more cautious than SIA. I think whatever expectations you have, it might have already been reflected in the market cap, number one. And you can see the recovery will be, I'm not sure there's any recovery now, but whatever recovery is going to take some time before you hit the pre-pandemic levels. But in terms of market cap, it's really kind of exceeded the pre-pandemic levels. So I think we're quite cautious for us, at least for SIA. Last one for me, second last one is telcos. In a nutshell, telcos is very disappointing, I think. This chart basically, rather to then show the ARPUs like we did in the past, we wanted to show you the EBITDA or profitability of the two telcos, StarHub and Singtel combined, through the last 20 years. So you can see that during 3G, they had a good time. During 3G, you had new users, then you can start to charge people for SMS. Right now it's free. So you can start to charge, there was new revenue source. Times were good. I mean, you got new subscribers, data, and so forth. But when 4G came, you can see profitability came down then because a lot of the value went to the apps. I guess the chart will be on the flip side, for someone like Facebook, and I think we all know the familiar name. So a lot of the value created was by the apps, not by the telcos. And in the end, the telcos had to fight on price. And when the arrival of the fourth mobile operator, I think we all know this. I think the things just continue to slide, especially the profitability. The near-term challenge is roaming. I think Malaysia is key. I think almost a quarter of roaming revenue comes from Malaysia. So if Malaysia don't open up, roaming revenue cannot recover. Of course, another one is China. So the next battle, we don't have the table, of course, because the next battle is 5G. And who will win? I have no idea. Actually, I don't even have an answer. That's why I put a question mark, because the feedback you get from the telcos is not very encouraging. They themselves are searching for what is their so-called killer app for them. So I actually have no answers whether the telcos can actually rebound with 5G. A lot of it seems to be focused on enterprise. The hidden value for the telcos, especially for StarHub, is the cybersecurity. I think we all see in the news, cybersecurity, the ransomware so far continues to escalate, and there's a lot of hidden value, I think, but so far it's still relatively small. Of course, the main talking point now is for Singtel is on the restructuring of assets. We are a bit neutral on it because they're doing, it's fancy word restructuring, but essentially Singtel is just doing a sale and lease back. They sell the towers, then they rent it for you, and the value is ultimately how much you rent. So if I sell my house to you, then I rent it back, is it creating value? I'm not very sure if that's actually creating value. So we are actually neutral on the telcos. A last one for me on the sectors before we move to stock picks is on the tech sector. The table on the left just shows foundry spending. So this is the amount of money that TSMC, Samsung are going to Intel, they're going to spend on building new wafer fabs. So you can see if you speak to anyone in a semiconductor, especially that's involved in the front end, the lead times have doubled or even tripled. They can't cope with the demand. And one of the reasons is the chart on the left. You can see 2021, there's a big spike. So what you're seeing is that Intel is building new fabs. TSMC is building new fabs, and of course the Chinese also need to build new fabs. I'm not sure if they are profitable fabs, but at least they have to build because of strategic reasons. So you got foundry spending doing well. So the one on the right is cloud. So even as we speak now, Zoom is using cloud, so everything is stored on the cloud. So as more things go online, shift to the cloud, you also get this big spending. The chart is actually a combination of Facebook, Amazon. Of course, not everything is cloud, but not just a proxy. So you can see that, especially with the pandemic, you got this big 32% jump in cloud spending, and then you get 14. So electronics is doing very well. Just that the component shortage is going to hurt some of the electronic companies listed here. And Singapore, as so many privatizations, there's very few electronic exposures left. The one that benefit on the left is someone like UMS. So because they are the ones who were all this plus 32 plus 2%. So all this will be record years for them because they will be the ones who will be benefiting from this plus 32% plus 2% foundry spending, because they're the ones who will help make the equipment for all these foundries like TSMC and UMC. Okay, in view of time, I will just move on to our stock picks. So this is how we decide what to pick. As usual, we have our model portfolio. There are two purposes of doing this model portfolio, these are our preferred stocks. We're supposed to generate absolute return. That's why it's called absolute return. And also, just to give transparency, we don't want to recommend a stock and then have no accountability and transparency. How did the stock perform? So the table on the left are the names that we prefer, and in red box these are the new names, Ascenders and DBS. What we took out was Manulife, US REIT, and Propnex. Propnex, because the share price just did very well. I think you saw the earlier chart. It's up it doubled this year. It's up 50-60%. So we took it out. So that's the portfolio on the left. The table on the right is basically the performance. Again, this is just a hypothetical one because everything is rebased to 10%. I don't go so detailed, but this is just a hypothetical how we perform. Now, what happened was that we got hit badly by Yoma. I mean, it's due political, I mean, not so much on stock picking, but just the politics change, and that's why you saw this big underperformance in February and even in March. So we are hoping fully we can claw back that. Just one last point, every quarter we will give some summary of how we perform. So the last quarter was let the guard dogs out because we did so badly. For this quarter, we just want to highlight that even though shouting out, even though one or two names did well, like for us was Q&M, it was up 24, then and also Propnex is up 60%. It doesn't matter. I think when you run a portfolio, just a reminder, shouting out one or two names, like some fund managers like to do, shout out that they had one or two stocks. It doesn't matter. Ultimately, you have to look at the whole portfolio. So even though we had one or two stocks that were up 20, even 60%, the portfolio was only up about I think 8% for the quarter. So this is just our little summary for how we perform for the quarter. Anyway, not to take up too much time, I think we can move on to the stock picks. Move on to Natalie.
Hi. Okay. So we start off our stock picks with CapitaLand. Okay. So CapitaLand, as you know, is a diversified real estate player. They have assets on their portfolio ranging from your retail, office, industrial to your hospitality, and also, of course, not to mention their own development pipeline. And because of this diversification across asset classes, we're seeing that they are more resilient to property cycles, and therefore, they also are able to provide more stable earnings. Yeah. So some of the earnings that we feel are stable and quality recurring income comes from the fees that they collect from the management of their REITs as well as private funds. So this fee income is actually based on the amount of assets under management, AUM, that they currently manage. Also, not to mention their lodging platform, which is the Escort Limited, wholly owned by CapitaLand. They of course collect fees for the franchising and the management of the lodging assets, which are a global portfolio. Last of all, the recurring income comes from your investment property, such as the ownership of some of the malls, such as Ion in Orchard Road and all the other industrial assets that they have which is carried on CapitaLand's books. So this provides a recurring rental income. So for CapitaLand, the growth actually, they are actually trying to funnel the growth in the AUM of the REITs and private funds. So if you look at the graph on the left-hand side, this is the AUM for the REITs and the private vehicles. So they want to grow this AUM. Currently, they're at about $79 billion. They want to grow it to $100 billion. Yeah, and that, of course, as mentioned, it will increase the fees that they are able to collect for the managing of the AUM. Okay. CapitaLand also has committed to a $3 billion asset recycling program. So currently, I think as of May or as of June, they have recycled about $2.7 billion worth of assets. The latest divestment, of course, comes from the divestment of two Japanese malls located in the Greater Tokyo region, and for almost $500 million, and that actually unlocked 100 million in net gains for the group. Okay. The last point for CapitaLand, our target price is $4.38, and if you recall, that it's actually higher than the $4.10 number for the purchase consideration. So part of it is, of course, due to this demerger being able to provide re-rating and for the fund management business, so that that will also the re-rating basically review is positive from the decoupling of the development portfolio from the more recurring fee-based portfolio. Yep. So now moving on to my next counter, which is Ascott Residence Trust. So first of all, starting off from the portfolio, Ascott is diversified by lease type as well as by geography. In terms of geography, they have 8 key markets which drive their earnings, and so that actually reduces the volatility from owning assets in different geographies. Yeah, and in terms of lease types, if you look at the pie chart on the left-hand side of your screen, first of all, just a little bit of explaining here. They have 3 different types of lease types. First of all, master lease, which are the stable leases, and they will just earn a fixed rent to a certain extent. And then they have the MCMGIs, which stands for management contracts with minimum guaranteed income. So these 2 lease types are considered the stable lease types because they actually provide a minimum rent. Okay, and then moving on to the variable or the growth type of rents, lease structure, that we have the management contracts. So this is pretty much very variable in nature based on the occupancy as well as the room rates. Okay, so the Ascott actually strives to have a balance between stable and growth leases. So they want a 50-50 split. And if you recall, FY20 was a very bad year for the hospitality sector. And we saw that the stability from the master leases actually shone through. Okay, in 2020, the master leases and the MCMGI, they accounted for more than 2/3 of the gross profit. Yeah. Okay. Conversely, moving into FY21, we expect to see the management, the stable leases actually contributing a smaller portion as the variable income sort of picks up and goes into recovery. Okay. Second of all, of course, is Ascot's, as mentioned, right? They own assets globally, and this diversification and actually leads to a 69% of exposure to countries with large domestic markets. So some of these markets are the US, Japan, Australia, France, and of course the European nations. Yeah. And so because of these large domestic markets, we expect that these markets will pick up first, recover faster, and because of Ascot's 69% exposure to these countries, we are expecting Ascott to have a potentially faster recovery than some of the hospitality REITs listed on the SGX because of their focus on the Singapore market. In terms of growing their stable income and Ascott targets to double their long stay portfolio of PBSAs, which stand for purpose-built student accommodations, as well as the rental housing income to 15%. So currently they are about 7 to 10%. Yeah, they want to increase it to 15%. Yeah, and these kind of asset classes, they are very stable in nature because they have a very long average stay, length of stay, more than 1 year. Yeah. And high occupancy, even in 2020, these asset classes actually maintained an occupancy of above 95%. So this will provide income stability for the portfolio. For Ascott, they have also managed to recycle some of their assets at very high net gains. Some of these they've been able to divest assets at yields of about 2 to 3%, and then they take these divestments and they reinvest it into new assets with yields of 4 to 6.5%. So this, of course, will help the REIT to actually unlock value. Not to mention all of these divestment gains, they can be used to sort of support and increase the DPU, especially in the years where the earned DPU is slightly lower. Okay. The last point I just want to touch on very quickly is the sponsor support. So as mentioned earlier, their sponsor is actually the Ascott Limited, which is a wholly owned subsidiary of CapitaLand. So this sponsor actually provides support in terms of operational support. In 2020, we saw that some of the Japan assets under WBF, they were undergoing some kind of liquidity problems, and in event of any default, the sponsor, which also has presence in Japan, can step in to take over the operations. So that actually provides continuity. Yeah. Even in the recent case where we see for the asset in Liangkok, which is Park Hotel, yeah, the sponsor can potentially step in if anything goes wrong to take over the lease. So. Okay, I'll just move on to the next counter, which is Ascendas REIT. Once again, the story here is diversification. In terms, if you look at the pie charts on the left-hand side, diversification comes in the form of geographical diversification. Singapore is still their largest market, forming 60% of the total investment properties. And they also have a good exposure to Australia, United States, as well as the UK, Europe. Okay, in terms of asset classes, business spaces which include your business parks, your suburban offices overseas. This accounts for 46% of the space, as well as data centers, which now form 10% of their portfolio after the acquisition of the European data centers earlier this year. Industrials and logistics account for 21% and 23% of the portfolio respectively. So because of the exposure to the logistics, data center and business space, these asset classes actually are able to capture demand from new economy sectors such as tech, biomedical, which are your life sciences, your precision engineering, and of course the e-commerce side, which is your logistics side. For in terms of scale and diversification, with 209 assets and 1,460 tenants in their portfolio, the concentration risk of any asset or any tenant is actually very low. It's below 4% in terms of per asset and below 3.8% per tenant. Yeah, as in the largest tenant and the largest asset. Okay, so that actually means that any non-renewals in any asset or by any tenant has a very small impact to the REIT. It's still able to be resilient and stable. For Ascendas, we like them also because of their active portfolio management. They have done a lot of AIs and redevelopments, and because of their size, they can actually undergo or undertake redevelopments without a significant impact to their NPI. Yeah. So overall, they have in terms of AEI for the year, they have actually done 338 million worth of AEIs and redevelopments, and in terms of acquisitions, so far year to date, 1,700 million in acquisitions to grow their portfolio. Okay, so that's all for Ascendas. Our target price for Ascendas is $3.65. Yeah, okay, thank you. Moving on to Fraser Centrepoint Trust. This is one of our top picks. For Fraser Centrepoint Trust, this is, for those who are not very familiar, they own a portfolio of predominantly suburban retail assets. These are the assets that are, for example, Causeway Point, North Point, Waterway Point, yeah, and these are all located in the heartlands, which is, first of all, very close proximity to households, and these households provide necessity-driven spending. 54% of the GRI, in terms of tenant mix, they're actually from essential services sectors, such as your F&B, your restaurants, some of the services which include like hairdressers, the doctors. These are these are essential services, yeah, and they contribute 54% of GRI to the portfolio. Okay, and if you look at the graph on the left-hand side, this is Fraser Centrepoint Trust tenant sales versus the RSI. So as you can see, in the second half, right-hand side of the graph, the red line, which represents FCT's tenant sales, has outpaced the RSI in terms of the recovery in terms of like growth. Yeah, so it has sustained the recovery above the general market. Okay. Overall, because of the proximity to households as well as the larger daytime population from remote working or your flexible working arrangements, we believe that the demand for suburban mall space will remain strong. And not to mention, because of FCT's portfolio, which consists of larger malls, these larger malls tend to be more tend to be prioritized whenever tenants decide to expand, or even when they're contracting, they might want to retain the space in these malls versus another smaller mall, or a less well located mall. So to wrap things up, Fraser Centrepoint Trust's increase in catchment size will also help to lift tenant sales, as mentioned earlier, permanent hybrid work arrangements, and for the malls in the north of Singapore, these malls actually benefit from almost 67% growth in HDB units. So of course, these are the BTOs that are coming up in the north area. Yeah, and an increase in the catchment size just means that there'll be more people coming to the malls and spending money on groceries and food. Okay, and the last point, of course, is that there are two decentralized commercial clusters in the north. One of it is in the Woodlands area. So as more working population, as more people travel to the north side for work, that will also lead to increased footfall for the malls. So Fraser Centrepoint Trust, our target price is $2.79, and that actually represents a yield of about 5.5%. Now moving on to Capital DC. For Capital DC, currently they are pure play in data centers, and data centers, as we know, they are resilient and future-ready essential asset class. Even this was highlighted during the pandemic, of course. The importance of data centers. They were considered an essential asset class, and even as the lockdowns were in place, the workers were still allowed to go back to the data centers to manage the data centers and ensure that everything goes smoothly. Okay, so in terms of demand and supply gap, especially in Singapore, which, as you can see from the first pie chart, Singapore represents about 57 or 58% of the revenue by geography. And most of these leases that are in Singapore are actually the co-location leases. So co-location leases are the ones where they are fitted out and they are managed to a certain extent. There's like, yeah, okay, so they are able to charge a higher rent above the fully fitted and the shell and core kind of assets because of the management fees that are charged as well. Okay, and in Singapore, which is their largest market, as we all know, the moratorium on data centers still remain in place. So that means that the supply is actually kept in Singapore, and the thing about the co-location leases is they are actually on a shorter wheel. So they are expiring within 1.2 to 1.8 years, and this will coincide with the gradual the rents being bidded upwards. So yeah, okay. Overall, we also like Capital DC for the ability to unlock value across their existing assets. So over just last year and the year before, we have seen them conduct AEIs on some of their assets, including Capital DC 1, 2, 5, DC1, Dublin 1, and Dublin 2. So what has been done for these assets are, for example, where they convert a non-data center space to a data center space, allowing them to, of course, charge higher rents, and because data center space actually commands higher rents, and also bring on additional power, allowing them to lease out some of the space. So these are all value enhancing kind of AEIs that will lead to higher revenue collection. And another thing to note is that some of these AEIs are actually done on a pre-committed basis. So they already managed to secure this tenant that needs more space or wants more power before they actually embark on these kind of AEIs. Last of all, the expansion of mandate for Capital DC may accelerate inorganic growth. So for Capital DC right now, what is going to, they have unlocked almost what they have conducted so many AIs and unlocked as much value as they can from their existing portfolio. So the only way to grow will come from inorganic growth, acquisitions, in other words. And this expansion of mandate allows them to acquire not only data center assets, but also ancillary kind of infrastructure assets like your subsea cables, your telephone towers. Yeah, and the reason why they are looking to expand this mandate is because some of these data center portfolios that are put onto the market, they also include some of the infrastructure assets. So by expanding their mandate, it allows Capital DC to potentially look at these assets as well. And just to point out, when they do invest in infrastructure assets, or if they do, it will be purely they're doing it from the point of view of a landlord. That means they are not going to take any operational risk for managing the telephone towers or what have you. So for Capital DC, our target price is $3.20, and we are forecasting a yield of about 4%. Moving on to Manulife. So for Manulife, first of all, located in the US, they hold a portfolio of trophy and Class A grade Class A assets, office assets. And for the US, the leases signed for the office leases are actually relatively longer. So the portfolio has a WALE of 5.3 years. Within the portfolio, 96% of their leases actually have a rental escalation clause. And on average, the rental escalation is about 2% per annum. And Manulife has managed to maintain an occupancy of 92% as at first quarter 2021. And this is above the industry average. In terms of subleasing, so what subleasing is basically space that has already been leased out to a tenant who now does not want the space anymore and wants to re-lease it to another player. So that's subleasing. And in terms of subleasing for the markets where Manulife has a presence in, as you can see from the table in the left, the graph in the left-hand side, the subleasing in the cities where Manulife has assets in, on average about 11.1%, where versus other notable gateways of San Francisco, Seattle, and New York, where subleasing in these markets are way higher, almost 30%. Yeah. So what this actually means is that there is actually less of this shadow space that is trying to compete with Manulife's own vacancy for tenants. Yeah. Overall, the office tenants remain resilient throughout the pandemic. Majority of Manulife's tenants are actually from the financial as well as the legal sectors. However, there's a little bit of a negative here because of these tenants. The tenants are actually so to speak better pay masters and driving rental growth are those from the new economy sectors like your tech tenants, your life science tenants. So because Manulife has a higher sort of tenant exposure to financial as well as legal tenants, these tenants are they are more conservative in a sense, and in terms of rental growth, the tech tenants and the life science tenants are the ones that are expected to drive rental growth. So I think Jie Hui will touch on this a little bit more later when she talks about prime. Okay. So that brings me to the last point, which is any future acquisitions for Manulife, they are going to be targeted at assets and cities which are preferred by these tech, life science, and healthcare tenants, because, as mentioned, these tenants are the ones that are paying higher rents, able to pay higher rents. Yeah. So while Manulife still provides a relatively good yield of 7.5%, we're actually switching our preference from Manulife to prime, and I'll let Jie Hui touch on this in the next slide. Heading over to Jie Hui.
Okay. Hi. Yeah. Next we have Prime US REIT. So Prime US REIT is also another US office REIT, and just going straight into the investment merits. Apart from the portfolio's diversification across geographies, assets, as well as industries, if you can refer to the chart on your left, we actually like that there's a greater emphasis on established trade sectors like your finance and legal, as well as growing trade sectors like your science, tech, and communication sectors. So these sectors are actually these tenants are either incumbent office users or sectors in expansionary mode. So in our view, this actually makes the portfolio more resilient. Just to share more color as well, amid COVID-19, rental collection rates have been high at 99%. Prime also has a long WALE and higher than average Class A office occupancy. So with minimal expiries coming up, we believe that Prime's income stream will still remain stable. We also like that we can expect stronger rental growth for the portfolio. Prime's portfolio is equipped with a rental escalation of 2% for almost all of its leases. And in addition, the portfolio in-place rents are actually below asking rents by about 6.5%. In other words, we should be able to see positive rent revergence going forward as leases expire and new rents are marked closer to market. Lastly, in terms of its new acquisition, its recent acquisition introduces 2 new assets in 2 new markets, and this actually increased Prime's AUM by assets under management by 15% and provided more exposure to key industry sectors like your medical and biotech, and increased diversification as well. So post acquisition, actually no single market or sector contributes more than 12% to the portfolio. And apart from that, the new assets acquired actually has a higher occupancy and WALE than the current portfolio. So all in, we are actually positive about Prime's recent development. So just to wrap things up together with Manulife earlier, we are still positive about the US office sector, given that more citizens are getting vaccinated and also companies are announcing their return to office. Some key dates to look forward to includes 4th of July as well as 1st of September, given that that is when more companies actually announce a return to office and more schools have announced their reopening. So just to conclude, our call is an accumulate with a target price of 94 cents, representing an yield of 8.7%. Next, please. Okay, so in our next slide, we have first sponsor. First sponsor is the developer, owner, and financier of property projects. Its main operations are in China and Europe. This company is supported by 2 key stakeholders, namely CDL and Untitled, both of which are recognized holding companies in Asia. We like that first sponsor is getting multiple streams of revenue from its development business through its complementary business lines. So starting with the development business, the main thing to note is that the Greater Bay Area, specifically Dongguan, the key market that first sponsor operates in, actually saw high demand for its properties such that most of its residential projects are sold out shortly after launch. Interested buyers were actually paying money just to have a chance to queue up to buy the properties. As such, it actually owns more than 600 million worth of revenue that has yet to be recognized, and its existing projects actually provide for a gross development value of almost 3.2 billion, which is worth almost 10 years of sale. We also like the high recurring income coming from the property financing business. So if you can look at your chart on the left, we are expecting an 18% growth in loan book and revenue for this year. The double-digit growth in loan book is due to the buoyant development market as well as the tightened credit market in China. So just to give you some color, banks in China are quite selective. They prefer to lend to state firms and larger listed private companies, and they usually lend on development and not land itself. So as a property developer, first sponsor can actually provide securitized lending for land purchases. First sponsor can also negotiate for an equity deal that conjoins both property financing and property development, which actually gives first sponsor more opportunities in both fields. So now moving to our last point on property holdings, office-wise is still stable. In our latest update with first sponsor, we understand that first sponsor's hotels in both China and Europe are actually recovering very well. So life is almost back to normal in China. People are not wearing masks, people are hosting weddings, etc. And Europe has actually recently eased its COVID-19 measures. Especially in the month of June, first sponsor actually saw a pent-up demand for domestic tourism. A number of hotels actually saw occupancy recovering to 60+% from about 10 to 20% occupancy a month ago. So with this final engine for first sponsor turning around, we continue to be positive on first sponsor. And just to conclude, our ratings are buy with a target price of $1.56. Now next slide. We have Pan United. So Pan United is the largest provider of ready-mix concrete and cement in Singapore. It's a market leader with almost 40% market share. So the main story for Pan U is that we are expecting a recovery in the construction demand in Singapore. If you can look at the construction demand chart on your left, we are expecting 2021 construction demand to improve by as much as 31%, led by public residential and civil engineering projects. So this actually includes your projects like Jurong and Cross Island MRT lines. And further ahead, we should still see a steady improvement from 2021 levels, boosted by more public sector projects. We are expecting PenU to benefit from this, given the high market share. So in our next point, we believe that there are high trade barriers to entry. So apart from having dominant players in the market, silo facilities are limited due to land constraints, and due to environmental reasons, patching plants have also gone up in prices in recent years. PenU has also, PenU actually has their own cement silos as well as slag producers and batching plants. And we like that PenU is invested in almost every part of the raw material supply chain and obtains most of its imported materials, mainly cement, from its strategic partners. This actually makes the upstream more resilient. And now moving downstream, PenU owns or manages virtually all the components and processes across the concrete value chain, from the innovation and production of concrete to the delivery to customers. So just to give you some context as well, concrete products should reach customers within 2 hours of delivery. So an efficient downstream delivery system is actually quite important. PenU uses their in-house technologies like AIR, which is their concrete management platform, as well as GoTruck, their truck hailing platform, to streamline day-to-day operations as well as transport materials without owning a single truck. So we actually believe that these innovations will continue to give PenU its competitive edge. And so to conclude, our call for PenU is a buy with a target price of 40 cents. This is all from me. Now I'll pass my time on to Vivian for LHN.
Thanks, Jie-Hui. So for LHN, they are a real estate management group, and we like this counter mainly for the two sub-segments that I'll be talking about today. So firstly, for its industrial properties and also the residential properties later, these two sub-segments are grouped under its business segment called Space Optimization, which also explains the title Flexible, Affordable and Adaptable Spaces offered by LHN. So firstly, for industrial properties, if you refer to the first bullet point on your right, they offer work plus store outlets, which are 70% occupied by e-commerce tenants and enjoy high occupancy levels of 90%. So for e-commerce tenants, many of them, they actually started their business from home. Then during circuit breaker, then they want to expand. They need more space to store their goods and do their packing. So work plus store outlets could be said to be the most affordable solution for them. Otherwise, they have to rent a retail storefront or go and look for industrial spaces. But work plus store outlets, they have renovation, everything in place. Utilities are also taken care of. Yep, and the high occupancy levels are supported by the increase in e-commerce sales. So if you refer to the graph on your left, the red line represents online sales as a proportion of total retail sales. So you can see that the proportion spiked in May 2020 during the circuit breaker period. Then it came down, but it's still substantially above the pre-COVID levels. So if you refer to the second bullet point on your right, year to date, May 2021, the total absolute online retail sales represented by the dark blue bars are up 21% to almost $1.9 billion. And for the online sales share or proportion, it almost tripled from pre-COVID levels of 6% in January 2020 to 16% that was recorded recently in May 2021. At the same time, LHN is also constantly on the lookout for properties to acquire to transform into work plus store outlets. Next, moving on to the residential properties. For the Hollywood portfolio. So for this portfolio, they are also enjoying full occupancy. So if you know anyone who wants to like move out of the house, look for a room out there, you could face some difficulty trying to get a room. Yeah. So we are expecting 4 projects to commence operations over FY22 to 23. And recently in this announcement that they released on the completion of acquisition of the Amber property, completion of the acquisition of the Amber property, which is also for the Hollywood portfolio, considered in the 4 projects. They also mentioned that they are actually aggressively looking to acquire properties for the Hollywood portfolio. Yeah, so we are expecting more projects to be announced over the next year or so. And for Hollywood, they offer flexible lease terms of minimum of 7 days, and also affordable rents depending on the location and the room type. So it ranges from around 1.5K to around 2.6 Currently in operation, there are 5 buildings and 810 keys. So in conclusion, we believe that LHN will continue to be an optimizer of real estate trends as the demand for serviced residences and also e-commerce continue to rise. So we have a buy rating with a target price of 54 cents. So that's all for me for LHN. I will now be passing the time on to Terence for DBS.
Yeah, thanks, Vivian. So for DBS is our top pick in the absolute 10. For us, we see for that's a recap of the first quarter 21 earnings. For first quarter, they actually beat our earnings estimates very, very strongly. So you can see here, they beat out for first quarter 2021 rather, their earnings came in at 34.5% of our FY21. And the reason why there's such a strong beat is because of the GP reversal. So it is table here is a little bit small, but if you look at the table here, they actually reversed out the general provisions in the first quarter of 2021. So for full year 2021, we expect earnings of $6.1 billion, and we think there's a very good chance that they will beat these earnings, given the strong growth momentum. Namely because the overall NIMs or the net interest margins has stabilized for the banks, especially for DBS also. The loans growth is also expected to grow at about 5% for financial year 2021. Again, credit cost stabilized, the further GP right back in financial year 2021. We also see the removal of the dividend cap as a positive catalyst, and a special dividend is expected after the removal of a dividend cap. So we maintain our accumulate rating on DBS with a target price of $31.40. Yep, in our next slide, for Capital Corp, we see two main catalysts for them. Firstly, the O&M merger with Sembcorp Marine, and the divestment we believe will drive divestment of their offshore and marine business will drive a re-rating of the Capital Corp group. So just to recap, Capital has announced two non-binding MOUs to exit the O&M segment. So the first is that Kyanite, the first MOU that they signed is for Kyanite Investment Holdings, a wholly owned subsidiary of Temasek, will procure external investors for Asset Co. So if you look at the table here, this graph here that we provided on the left-hand side, you can see the Capital O&M business in the restructuring they announced at the beginning of the year. What they did was to split the Capital O&M unit into three main units. We'll just go through what the three main units are. So they split it into Operating Co, or OpCo for short. Operating Co is involved in the developing and integrating offshore energy and infrastructure assets, whereas RigCo will put completed rigs to work, or they will try to sell some of these rigs. Then, whereas Development Co is to complete the rigs currently under construction. So in the first MOU that Capital signed with Kyanite Investment Holdings, what they will do is they will merge RigCo and Development Co here into Asset Co, this Asset Co business. And what Kyanite will do is that they will look for external investors to acquire about 80% of Asset Co. So if this transaction takes place, then Capital will only be left with about 20% of Asset Co, which makes it after that Asset Co will be a non-core holding for Capital already, because they already received 80% of the proceeds for Asset Co. And when we look at it from a longer term perspective, then it is Capital's aim to gradually reduce exposure to Asset Co over time, and we think that the most natural route for them is to completely divest Asset Co. Then the second MOU that Capital signed is the non-binding MOU to merge Sam Marine and the Operating Co, which is this first box that you see here on the left-hand side. So if this takes place, they expect to receive cash consideration of $500 million, an unspecified number of combined entity shares. We put here unspecified because they haven't determined the exact acquisition cost that they're going to acquire this, at what valuation they're going to divest of Operating Co. So once they decide this, then the exchange ratio will be decided, and Capital can then distribute all these shares to the Capital shareholders. So there's a likelihood that they could divest this at one-time book value, or maybe a slight discount to one times book value, but that clearly not a premium to his book value. So maybe just one at cost, they will divest this away. So this whole transaction, if completed, the two MOUs, if completed, will transition Keppel away from the rig building business into an asset-like business with a respectable 15% target ROE for the group. So we maintain our buy rating on Keppel with a higher target price of $6.20. So our target price increased slightly because we upped the O&M valuation from 0.7 times previously to now 0.8 times. So now we move it closer to 1 time, since if the transaction is completed, it will likely be at cost. Yep. So that's all for me for Keppel, and I'll hand over the time back to Paul.
Yeah, I think we've got to wrap it up soon in view of time. Just very quickly, I think Asian Pay TV, I think I mentioned this almost a year, so hopefully nobody switches off. But anyway, we just like it because the yield is high, 8.6%, and it's sustainable. From the bar, you can see dividends is the red bar, and the blue bar is the cash flows. And you got optionality when 5G rolls out, but 5G, the timeline is up to end 2024, so that could come in either next year, or maybe the following year. Very quickly, ComfortDelGro, I know it's weak, but why we like it is that the cash is building up. So even though operation is weak, you can see that the balance sheet, the table here, the balance sheet is now back to net cash of 20-odd million, even though you got a COVID pandemic. And also, this is our exposure to recovery because the stock price is still 30% below pre-pandemic. So we know the challenges, and Grab is still out there, but we think that there can be a bounce as things recover, and it's our exposure to the reopening of Singapore, I guess. Q&M is more organic. You can see that one big thing is the number of clinics from 117, 142, 175. They used to focus on acquisition. I guess once you got IPO, you get a bit wild with all the money. But right now, I think they're focused more on organic, slower, but more sustainable. And you will also get PCR testing revenue, which the COVID-19 PCR testing, which is a totally new, and we are looking at maybe a 30% lift in earnings from that. So this is just a summarized version. I will just quickly run through the conclusion. So the difference right now is, unlike 6 months ago, we have visibility, vaccinations underway, and that's a positive. And also the way we are positioning the portfolio just for position for aggressive reopening. But international travel will be, of course, the big unknown. We are less optimistic on that. And the macro conditions continue to be very conducive for equity markets. Low interest rates and improving economic conditions. Our STI target is 3.4. It's a slight premium to the historical PE of 14 times. So I think with that, again, this is our analyst team. If you wish to get the WhatsApp, and this is all our research is here. And if you wish to listen to any of our ListCo webinars, which I think we hold like 50, 60 a year with all the listed companies, hopefully to 70, then we take like 10% of all listed companies do webinars with us. You can just register yourself in the link at the bottom. Just look out for it, or just subscribe to our WhatsApp, and we will send it to you for automatic updates. I think we can take Q&A. Sorry, we're overrun, and thanks everyone for staying back with us. It's almost 2 hours. It's like watching a soccer game. So thanks for staying back with us and asking all the questions. Thank you. I think we can take some. Terence, you go ahead.
Yeah, sure, Paul. So in this Q&A segment, we'll take the questions from the Express Q&A first. So the first, we'll take the question with the most likes. So just a reminder, if you want to have some question answer, just like the Express Q&A for those who have the Express Q&A link. So the first question is, I'll just read out, is the impending lifting of dividend cap on Singapore banks being priced in already? And then there's a second question. Otherwise, what are the buy levels for the banks? So for maybe I'll answer the second question first. At these levels, we still see the banks as a buy, because for us we think that they are currently undervalued at these levels. Like we see our target price is higher than the current share price at the moment. So on the first question, is the bank, yeah, we think that because there's still uncertainty as to when the banks when MAS will lift the dividend cap. Like what we mentioned, we see 2 potential dates that MAS can do. So we think that while some of this is priced in already, there's still a little bit of what we think is a uncertainty premium, still not priced into the stock. But once MAS announced this, then the uncertainty premium will close. So when the uncertainty premium is reduced, then the share price should go higher in anticipation of not just number one, higher dividends, but also a potential special dividend that again nobody knows the exact quantum to. So that's all for that question.
Yeah, okay, let me just take one question. I think we can only take a number of questions. The rest, we will try our very best because there's 70 questions, or I think 80. We will try to send it to you via email. So the next question is, what's your view for commodity stocks such as Olam rights issue and Wilmar? Actually, I'm not sure why Olam needs to do some more rights. I think they've got like Temasek behind it. But anyway, we don't cover for Wilmar. You know, you follow them since the RTO, but it's hard to play Wilmar on a quarter-on-quarter basis. So the upcoming results is expected to be weak because the crushing margins are down. Soybean crushing in China, for those who don't know, because there's a bit of a shift from using to feed the swine is from soybean to even they're using grains now. So we think near term is weak, but no, Wilmar, sometimes it's hard to predict quarter because now apart from the IPO, they always do a bit of forward hedging, so your margins can be hard to predict. But for longer term perspective, Wilmar's strength is the comparative advantage. You know, so they supply oil to consumers. Now they're supplying flour, they're supplying sugar in China to all these consumers. So they have that big comparative advantage compared to the peers. And the next trend that they are playing on is essentially central kitchens in China. I think what's happening is that I think in future your restaurants won't be cooks, so they'll probably more become like food assemblers, and that's the trend that Wilmar is going to pursue in China. So I think longer term Wilmar is still good, just that in the near term people are expecting soybean crushing margins to be weak. And one last point, I think if you want to play commodities, sometimes the ETF may be better because the ETF you can ride on the price trends. But again, both stocks we can't comment, but I'm just giving you some cursory comments since I've been to most of their briefings. I think a lot of the questions are on China. So I think it's good that you post, these are very good questions, but probably you can post them to Louis and the China team for these very good questions. I think we'll just take one more from Natalie on Tasin.
Okay, sorry, give me a minute. Okay, so for this is from the Express Q&A as well. Dasin ditched the ARA for Sino Ocean and has a 500 million loan maturity on the 18th of July. Is this the same explanation to their price free fall? So actually for Dasin, their price actually they only gave an update on this maturing loan a few days ago, but their price started falling almost a month in advance. So it could be that there was some non-public information that came to the market, but our speculation is that because in the month of towards the end of June, there was also some listing of 9 China REITs on the Shenzhen and the Shanghai Stock Exchange, and although those are only open to Chinese investors, it could be responsible for some of the fund switching from Singapore China REITs to the China REITs. Yeah. Operationally, I think apart from this loan maturity, the China market has consumer market has also sort of recovered and is picking up. So on that front, it's more or less status quo, business as usual. Yeah. Yeah. So I think in general, the fall in share price, I think in part it could also be due to this loan maturity. Yeah. I think we can move on to some of the Q&A on Zoom.
Let's take the express questions. I think there's a few more. I think it's all targeted at your side, your assessment of, yeah. Can you just go through those first? We'll just use 5 minutes to answer questions. I think we can kind of end it for the express queue. Okay, let me just read out the question. In your assessment of the resiliency of suburban malls, what would be the impact of a permanent shift in buying behavior when online purchases are made even for basic necessities? How would this affect Fraser Centre Point? I think it's just the online the threat from online purchases.
Okay, so for that question, thank you for the question. So because of FCT's proximity to household catchments, and even with this shift of buying online, there is a possibility that the positioning of suburban malls will also be shifted to being fulfillment hubs. So it could be that some of your supermarkets, instead of fulfilling these grocery orders at their warehouses that are located in some of the industrial areas of Singapore, they can also use the stocks which are located in the malls itself for dispatchment of online orders. So overall, as the work from home population or the flexible working population, they stay at home more. FCT's malls can also be used for click and collect. Even sometimes, if you were to place food orders on your Grab platform or even through the Fraser Centrepoint app, you can also opt for picking up at the mall itself. So if you're using Grab, that will of course save you, some of your delivery charges or even a discount on sometimes Grab does offer some discounts when you do a self collect. Yeah, so the positioning of malls, yes, you still can buy your groceries physically. You can place orders online and then pick up from the store. And as part of Fraser's initiative of going online, they also do have an online store, e-store, where they can do this kind of fulfillment of deliveries. So I hope that answers your question. Okay, I guess I'll take one last question from this Express Q&A. Manulife REIT has been replaced by Ascendas REIT in the Phillip absolute 10. While the reason for including Ascendas is given, the reason for dropping Manulife is not. Are you still positive on Manulife? So yes, we still have a buy call on Manulife. And as mentioned earlier, the yield the forecasted yield for Manulife is about 7.5%. And I previously mentioned the merits of Manulife, which is their WALE of 5.3 years, rental escalation of about 2% for the portfolio. However, we are also shifting our preference for the US office REITs from Manulife to Prime. And I think in summary, the reason for this is because of the exposure to new economy asset tenants, such as your tech, your life sciences tenants, your media advertising tenants. These are the tenants that are not so price sensitive in terms of rental space, rents. So they are able to still provide good rental growth. And as mentioned earlier, Prime has a larger exposure to these tenants in their portfolio. And so we believe that, so we are also sort of changing our preference from Manulife to Prime. That being said, I believe Prime's yield is about 8.5%. So both of these REITs still provide a relatively good yield. Yeah.
Okay. I think we can just maybe take one question from the Q&A. I think it's Sembcorp, since there are 40 people who voted for it. Dennis, you want to try to the Sembcorp Marine?
I could escape. Okay, but I think I'll read the question first. Is Sembcorp Marine a good stock to look for long-term view on climate change and renewable energy? So actually, there are a few questions. Maybe I'll just read the question and then answer the question first, and then answer the next one, so that people don't get lost. So the first question is whether Sembcorp is a good stock to look at for the long term. Yeah. So I think that is probably the only way or the right approach to view Sembcorp Marine, because like what we mentioned, there are a lot of short-term disruptions to Sembcorp Marine. They have a lot of existing orders to fulfill. They have some of the legacy issues, the low oil price, and also some, because of COVID-19, there are some supply chain disruptions that's affected their operations overall. So for Sembcorp Marine, this current rights issue will really position them for the future and help them to compete in the new renewable energy space. So a recovery for Sembcorp Marine will not be something that will take place soon. Even if they merge with the Keppel O&M business to clean up the whole entity and really structure it to grow as a single unit, will at least be fourth quarter of 2022, we believe. So for Sembcorp Marine shareholders, they really need to a longer term view of the group as a whole. So the second question is, with current high oil price, any good chance to secure offshore business? So yes, for Sembcorp Marine, they've reported an uptick in terms of the number of orders that they are competing for and the number of orders that they have won. So in the first half of 2021, they actually managed to pick up a few good orders for Sembcorp Marine. And that's one of the reasons why they are raising $1.5 billion in this upcoming rights issue as well. The reason is because they want to strengthen their balance sheet to compete for such new contracts. So they will be in a better position, at least to ride out the seemingly protracted downturn and to ride the recovery as well. The last question which is quite good. So where are the competition coming from in the O&M contract space? So for this new entity, or for Sembcorp Marine at least, their main competitors are always the Chinese yacht players and the Korean yacht players who are also competing very, very strongly in the market and are very strong competitors for them. So for us, the two main competitors will be the Chinese and the Korean yacht players. Yeah, so that's all from me. I'll probably hand back to Paul to do a closing. Paul, over to you.
And just to add, even though the outlook is good, there's two major overhangs for Sembcorp. I think they might have to raise 500 million to pay capital, and they might have to issue shares to capital shareholders if this deal were to happen. And all these are free shares for capital shareholders. So obviously, when you get free shares, the first thing is going to dump it. But anyway, I think in view of time, we have to conclude. So sorry, I think there's a lot of questions. We will try to address them and send you email replies, so that we'll try our best. So I think we have to end. I think thank you everybody on behalf of Phillip Research Poems. Thanks so much for all your attendance and staying back. It's almost 2 hours on Saturday, so thank you so much. And we hope to see you in the next few quarters, or also listen to our usual monthly, weekly briefings. Thank you, and take care, everybody. Bye.